Earlier this year, there was a big battle. Kraft Heinz wanted to take over Unilever. And that was a battle of the systems. Kraft Heinz, the US food company, represents the shareholder model, aiming at short-term profits. By contrast, Unilever represents the stakeholder model, looking beyond the financial return, also at social and environmental dimensions. So it was a big battle between the two. What happened? Kraft Heinz offered a large amount of money, but Unilever refused. They didn't want to give up their sustainable business model. In the end, they were saved by Warren Buffett. He saved the day for them because Warren Buffett, the face of American capitalism, doesn't believe in hostile takeover. So the bidding stopped when Unilever said no. But what was actually happening? A really clash of models in finance. So on the one hand, the shareholder model, driven by maximizing profits, short term. On the other hand, the stakeholder model, looking beyond shareholders, but also at employees, customers, society, even broader, the environment, take a more holistic approach. And Unilever felt that the stakeholder model, which they are adopting, is more conducive to sustainability. Okay, what has this to do with finance and sustainability? Let me start with the environmental challenges. The first one, you all recognize this, climate change, global warming, leading to more extreme weather events, such as floodings and also droughts in Africa. So that is on the environmental side, and you can make more pictures. Also on the social side, things are happening, especially in the developing world. Poverty, no access to health or education. You've just seen a very interesting presentation on education, but it's not everywhere available. The United Nations has combined the social and environmental challenges together in the Sustainable Development Goals. There are 17 of them. It looks like a big amount. It is. But let's just look at it. Number 1, I discussed no poverty. Number 3, good health. Number 4, education. Number 13, climate action. And I would like to draw your attention to number 12, responsible consumption and production. What does that mean? That means using renewable energy, like solar and wind, rather than fossil fuels for consumption and production, recycling raw materials, then each time using new ones from the earth, and finally, no child labor for your clothes which you are buying. So, I see you thinking, what has finance to do with these sustainability goals? What has finance to do with that? Because they're all very nice to achieve. And, well, finance seems to be just about getting the highest return on investment. You all have seen this movie, Wolf of Wall Street, and you don't care about the morality, just the highest return. This is the standard image of the financial system, which you can find in London, in New York, but maybe also here in the Netherlands. So it's a standard image of the financial system. But what is the financial system really about? That's about allocating funding to its most productive use. So finance has the power to finance companies, projects which work on sustainable principles. It has the choice to do that. And in that way, finance can help accelerating the transition to a low-carbon, circular economy. And when we think about this transition, it's not only about the big oil companies and the utilities who produce electricity at the top left. You see there with high carbon emissions, that's on the vertical axis. You see electricity, gas supply. But there are more parts of the economy. Transport, cars, lorries, airplanes, using fossil fuels and producing carbon emissions. In addition, a big one is real estate, houses where you live, offices like where we are today. They use a lot of fossil fuels for heating and cooling. And finally, as you would all expect, a big one is the manufacturing industry who uses fossil fuels for production. So all these sectors combined are a big part of the economy, the value added in the economy. So the transition to a sustainable economy really affects almost the whole economy. So it's not just stopping with the big oil company, it is affecting the whole economy, this transition. So that means that finance has the opportunity to finance these sustainable companies and stop financing the unsustainable companies, even if they have a higher return. But why would finance give up its return and do that? And I think that's the core issue this afternoon. And that's a question about what is the objective of finance. And what I would like to do with you is ranking these three factors, these three dimensions: the financial dimension, the social dimension, and the environmental dimension. And if you look at this, what I call a wedding cake, it starts with the foundation. That's the environment. That's our planet Earth. And we all understand that we need a viable planet for society to thrive, the second layer. The next thing, if we want to have a vibrant society, we need an economic system to organize production and consumption. It's quite clear that the economic system is the final bit of the equation, not the starting point. But if you open any economic or finance book, it starts with the economy as the center, and I would argue it is the end. It comes at the end. The environment and the social dimension is more important. So how to rank these three factors, the F for finance, the S for social, and the E for environment. So here I have a little table, and I will walk you through it. So in the first one, we get the shareholder model, which maximizes financial return and is aimed at the short term. That's the first one. The second one is a stakeholder model that looks beyond the financial return at employees, clients, society, environment. So basically financial, social, and environmental values are combined. They are together optimized. And it is important to note that we now get a switch from the short to the long term. And that's really crucial, this long-term orientation. But even psychologists would say, behavioral psychologists would say, we're all focused on the short term. So how do we get to this long term? And the whole financial system is built on the short term. Quarterly financial reporting. And if something happens with a company, you have to explain it after the stock exchange is closed, and the next morning you have to give a full press release. So quarterly financial reporting, your performance as investors each quarter benchmarks against the market. Are you doing better or worse? And I'm arguing for a long-term approach. How do we get there? I think there are three factors at work. The first is just plain self-interest of the financial industry. So, if global warming goes further, then at some point climate policy will adopt carbon taxes, or even further, may ban fossil fuels completely. And we have now the big debate on closing our coal-powered station, and the government has the power to do that overnight. When that happens, and a high carbon tax, then the big oil and coal companies become more or less worthless. And that's what we call technically stranded assets. So As an investor, you don't want stranded asset on your balance sheet. If global warming leads to regions which are really affected by all these floodings, then it will follow, what follows is always economic decline, and it means poor markets for your products. So that's a self-interest reason. The second reason for going from short to long term is pressure from society. I already said it a bit before. It is no longer acceptable that if you buy your clothes, that child labor is used or underpayment. So, and that is reputation risk for companies and the investors behind it. And the third one is related to that are the shifting preferences of managers in the financial industry, in corporates, the young generation, like you here today in this audience, are increasingly paying attention to the social and environmental factors, and in that way, the S and the E factor gets into the equation. Okay, so we see these factors at work, but still how to get there. And as economists, we have one, I wouldn't say small, a big bias, is where are the incentives? When I first did my presentation, the first question I got from the audience is, what are the incentives to do this? Because it is a nice story. So, let's start with the first incentive. You can see social and environmental dimensions as risk factors. We discussed the flooding, the reputation risk. If you use child labor or use underpayment, you see that happening, for example, with Apple, these discussions. So, what do finance people like to do? They love to manage future risks. Risk management is a core course in any finance curriculum. So we can see it, we can manage the risk. There's one reason to look at the long term. The second one is, I complained about this quarterly reporting, quarterly benchmarking. One way to get managers to think beyond the next quarter is to defer their pay. For example, if part of their salary is dependent on how the company is doing, the performance of the company in 3 years' time, they start to think, what is the impact of my decision on the company in 3 years' time? So in that way, you bring the future today in the pay package of the manager. The third thing you could do is long-term investors rewarding for their engagement with the corporate, so they stay with the firm. And if, for example, if they stay for longer than 3 years, they get extra shares. We call it loyalty shares. That's one way of making that investors stay longer with companies, because the other end of the equation is high frequency trading, who sometimes only have a share 1 minute in their portfolio. So we want engagement of the investor with the firm. This is all theory. Let me give some real concrete examples. Institutional investors are now increasingly using ESG, that's environmental, social and governance factors, in their investment decisions. To give an example, some Dutch pension funds have pledged to halve the carbon footprint of their investments by 2020. That is now only 3 years away. So there's an actual example of investors who want to reduce the environmental impact of their investments. So they are buying companies who are low on carbon and are selling their high carbon assets. Also, banking can have its impact. Earlier last month, Philips, and you all know it, the big electronics company, got a 1 billion credit facility from a syndicate of international banks, and the interest rate is linked to the sustainability performance. And that can be measured independently by outside parties. If sustainability goes up, then the interest rate goes down. And of course, vice versa. In that way, Philips, who has as mission better health for people, and also sustainability. It's part of the sustainability program, but at the same time, bankers can incorporate these sustainability challenges into their lending practice. That are two concrete examples. That's the good news. There are also limits to sustainable finance. And these limits are really there. The first one is, if you look at what is happening in the financial sector, then the short term is still extremely dominant. Especially in the Anglo-Saxon economic blocks, their short-term and shareholder thinking is still at the forefront. So a large part of finance is still unsustainable. However, I mentioned the forces that the part of finance which is looking at sustainability is increases, but we have to admit we are at a low part today. The second thing is, the private sector cannot do it on its own. If I talk about the social and environmental challenges, then we all know what the obvious answer is: government regulation. So the government has to do its part. Only the threat of carbon taxes, or actual carbon taxes like in Scandinavia, which is really ahead of the game, makes that investors will start to sell the high carbon assets because they hate stranded assets on the balance sheet. So we also need the government to do its part. Now, I come to an end. How can we make this happen? How can you and I make this happen? The first step is, we see in the financial industry coalitions of financial firms, 30 to 40% who already start to adopt principles of responsible investment. So that's a very good starting point, that 30 to 40% of financial firms avoid child labor, care about the carbon footprint of their investments. Even one step further, there is, although it is tiny, 1%, I just measured it, 1% of global assets, there's a tiny group of financial firms who put social and environmental factors first and financial return second. That's happening because they really believe that with a sustainable economy, we can leave the planet for current and future generations. Now I'm coming to you. You are today students, but you will become future leaders in the financial industry. You have a choice of what type of financial institution you want to work. Do you want to work at a profit-driven financial firm, or do you want to work for a firm who cares about long-term value creation? And then I mean long-term value, financial, social, and environmental value. That's the choice in your professional career you're facing. But you're not only economists or finance people or consultants, you're also consumers. And you can inform yourself about the sustainability of products and vote with your wallet. So you can be a responsible consumer. And sustainable finance is about the future, our future. Thank you.
Dirk Schoenmaker.